Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we're joined by Brett Swarts. Hey Brett, how you doing, man?
Barry, better than I deserve. Glad to be here. Thanks for having me.
I like that answer. A lot. Well, cool. Well, thanks for joining us on the show today. I'm excited to dive into a lot of great stuff in today's conversation. But before we do all that fun stuff, do you want to give us an idea about who you are and what you've been up to?
Absolutely. Thanks for having me on the show. So yes, Brett Swarts. I'm from Sacramento, California. Originally from the Bay Area, Mission, San Jose. Grew up with my dad building houses and having rental properties, kind of learning the sticks and bricks of real estate at a young age. Grew up a big wrestling fan. Hulk Hogan was my guy, and just love sports. Love playing football. Played basketball. I had the fortunate opportunity to play basketball in college on scholarship. A 6-foot white guy who could shoot and pass. And so, small NAI school, nothing big, but it still was a lot of fun. And then I fell in love even more with real estate when I took an internship to work as a real estate agent at a commercial real estate brokerage firm. That firm was called Marcus & Millichap. This was in 2006. So I started to learn how to underwrite property, how to own property, how to manage property, how to sell property, and everything that's involved with multifamily investments in particular. But it wasn't always easy, so I started out. It was 2006. The market was going pretty high. It was a great time to kind of be in the market, and transactions were happening. But then it quickly became apart in 2008 when everything crashed, right? So I went from making a little bit of money to almost nothing overnight. And I don't know if you've ever been somewhere, Barry, we're not sure how you're going to provide for your family and how you're going to, if you feeling like a failure, but that's kind of where I was at. And I was like, wow, for the first time in my life, I'm not making it like I always used to, right? In college and sports and academics and everything else. And because commercial real estate brokerage is 100% sink or swim. You either make zero, right? Or you hit it big. There's no benefits, there's no salary. And so I did what every good real estate, I guess, or entrepreneur wannabe does. You get a side job hustle. And I worked at a place called Cheesecake Factory. And so I also moved in with my brother into his condo, my wife and our small child. While a lot of people are saying, go get a real job, I said, I have a dream and a passion to keep going here. And so I just, by day I would work day I would work Marcus & Millichap, by night I worked Cheesecake Factory. And along the way, the journey, a gentleman came in. He played for the 49ers at one point. He's also a sports guy. And he taught me, he's a financial advisor at the time, taught me how to use the deferred sales trust to grow my business and help my clients out. You see, because my clients were going through this challenge too. And the challenge was that they had almost lost half of their wealth, or some lost all of their wealth. They were fighting with the banks. They had overpaid via the 1031 exchange, not a lot of inventory. Right? They knew they were overpaying, but they felt trapped by the capital gains tax, hence the 30 to 50% in depreciation recapture and capital gains tax, depending on what state that you're in. So now I'm negotiating with them and the banks by day, and by night I'm trying to keep the lights on at Cheesecake Factory. But we figured out there's a solution for that. A lot of people said, should have called me 3 years ago. Should have called, I wish I would have known about it. Maybe in 10 years when my values are back up, but stay in touch. But my business started to grow as I help clients solve problems. And I always say I'm not in the business of really tax or real estate. I'm in the business of solving problems for my clients and friends and family and clients. And so I did that. And all of a sudden, fast forward 10 years later, it's the overnight success, right? Now we have the podcast. We help people do deferred sales trust, a multifamily broker, growing companies, and wife's been able to stay home full time with our kids. We have 5 kids now. And we're passionate about helping people with escape feeling trapped by capital gains tax.
5 kids. Sorry, forget the real estate stuff for a second. Either your wife is amazing or I'm sure your wife is amazing, sorry, but how do you cope with 5 kids? I have one, and sometimes I feel like the world's engulfing me with problems and stuff like that. So how do you cope with 5 kids?
Yeah, it's no longer about managing time, like college days or early career days. It's really about managing energy, right? And so it starts with health, starts with my faith, starts with working out, starts with, making sure I'm putting my wife first and our marriage first, right? So we can be strong and then we can be there for the kids. It starts with a lot of family support. My mom and grandma watch the kids a lot. Having cousins around, having, lots of just local hometown support. If it wasn't for that, we probably wouldn't have more than 2, because I know what you mean. 2 is a handful. 1 is plenty, 2 is a handful.
Yeah. Well, I have a newfound respect for you, more than I already had. Right, 5 kids is just a lot. One, one is a lot for me. But going back to that time, right? And I want to dive into the deferred sales stuff, sales trucks. But the mindset stuff is always interesting to me. And that time, like you said, when you hit that hard time and you had to get a job at Cheesecake, and you were, a former athlete, work with your dad on the building site, right? And it seems like maybe at that time you had to eat some humble pie and just, move in with your brother. And from a mindset point, I'm sure it was tough, right? Mentally to be like, what am I doing? Where is this going? And I'm sure a lot of people might be going through that same thing now over what's happened over the past year and trying to figure stuff out. I was just wondering, from a mindset perspective, how do you overcome that? What were you telling yourself? What were you going through at the time, maybe, to help other people?
It's a great question. I would say a number of things, but I guess the thing that kind of kept me going is the belief that I could achieve, and I was in the right calling for what for me, it's my faith, where God was calling me, and that calling was the real estate industry, right? It was commercial real estate. It was wealth creation. It was the ability to get freedom by owning real estate that pays you cash flow, so you can spend more time with family, or support the causes you believe in. So I had some great mentors and people that were speaking life into me and encouraging me, right? Even though a lot of what was going on was very difficult, right? So I would say it was kind of a mixture of making sure I had the right voices speaking the right life into me, and believing that I could do it, as long as I persevered, remained humble and coachable, and open to what the future held for me. And but yeah, that wasn't without its challenges, right? I also got a medical sales job along the way, right? And then I also, worked nights and weekends doing basketball tournaments back at my college, and so it wasn't just, it was a 2-year stint at Cheesecake Factory. And then, so there's a number of things that happened from '06 to 2021, but all of it, looking back now, I've realized, and that's the one thing I would say to someone who's in this spot, is what you're going through might just be in preparation for what you're supposed to be doing, right? Just because it's tough, that might be the stuff that's fortifying and I guess, putting the fire to who you're supposed to be, so that you can help more people now. And that's exactly where I find myself. And I feel like everything I went through, that journey, has prepared me for such a time as this.
That's amazing. And I hear that time and time again, right? There's always setbacks, right? And what's that saying? There's every setback is a chance for an even bigger comeback, right? Because the stuff that you learn through those hard times, it builds character. And it's not ideal to go through it. And at the time, it doesn't seem like it's the best thing in the world. But if you use it right, if you keep the right mentality, like you said, and you have that belief that you're on the right path, those tough times will build you for an even bigger success down the road. I truly believe that. I hear it time and time and time again.
Absolutely.
Yeah. Well, very cool. Well, thank you for sharing that, man. Well, let's dive into it. You just talked about it a little bit earlier, the deferred sales tax trust. People are listening to that and they're like, well, what is that? How does it work? What does it entail? When do I use it?
Absolutely. So most high net worth individuals, or even those who've bought cryptocurrency at a low price, or a primary home, or a business, they struggle with capital gains tax when they go to sell. And it's somewhere between 30 and 50% of the gain, depending on the depreciation recapture and depending on what state they live in. So we use a deferred sales trust, which is just the tool, the strategy, to give them tax deferral, liquidity, diversification, and the ability to eliminate the need for the 1031 exchange forever. All so they can create and preserve more wealth. So I'm going to give you a few stats, and then we're going to dive in right into what the strategy is. So this is the first step to really understand what's happening. We call this the perfect storm, and I think there's 3 storms going on right now. And we'll start with the one huge storm, which is the demographics. So according to the American Bankers Association, there's about $17 to $20 trillion, Barry, that's going to transfer from one generation to the next in the next 20 years. Now, this is the baby boomers, okay? So these are our parents. And our parents have accumulated, according to this study, the most amount of wealth in the history of the planet, okay? And over the next 20 years, they're going to be what? Transferring that to their kids. Now, that same study found there's about 77 million baby boomers in the US alone, and about 10,000 are turning 65 every day. So this next part of this perfect storm is, how do they transfer it without getting hammered by capital gains tax? And how do they sell and retire from a lot of this? What is this? High-end primary homes. We just helped a gentleman out of Palo Alto. He sold an $8 million primary home and he moved to Nevada. not Henderson, not too far from you, right? And his big thing was he wanted to downsize. He wanted to get in another state. He wanted to move closer to a place where he wanted to be in, right? So that was his transformation for him, right? The next thing is it works for business owners, right? Business owners that are selling, own a dental practice, and we're helping an oral surgeon in Los Angeles right now. We helped the gentleman who sold it out of Alabama, a business, a marketing business, and you can defer the tax and then move that into the next thing that you want to move into. So all of this is happening. That's the first part of the storm. They want to sell, they want to retire, they want to downsize, they want to move to closer to grandkids, they want to start the next business venture. But this 30 to 50% in capital gains tax is restricting them. And or what other strategies they have, such as the 1031 exchange, don't qualify. Like the 1031 does not work for a primary home. Doesn't work for cryptocurrency. Doesn't work for a business, right? It only works for investment property, which leads into the second storm. And this is the political storm we're facing right now. And the political storm, the Biden administration is proposing potentially to limit or eliminate the 1031 exchange except for $500,000 of gain, which essentially eliminates the 1031 exchange for a huge number of people. So if you've owned a property, let's say for $1 million and you're selling it for $5 million, you've owned it for 20 years, well, guess what? They'll give you $500,000 deferral, but that other amount, that additional amount of 3.5 would be taxed at capital gains tax or even ordinary income tax rates. So it's very, very challenging right now for people should that pass. The second thing is inventory is so low, right? Inventory is so low, making values of properties skyrocket, which leads me back to the 05-06 days, right? We knew it wasn't a good time to buy. We knew it was a great time to sell, but it was a terrible time to 1031 and buy. And that's where people got hurt, right? They had too much debt, not enough liquidity, not enough diversification, and they knew they were overpaying. They were letting the tax tail wag the investment dog. And so with the Deferred Sales Trust, we can help them escape these challenges, okay, with the politics, with the perfect storm with baby boomers, and with the low inventory real estate market. Also, we'll add a couple of things on the politics side. They're also proposing to take away or eliminate the stepped-up basis, which is huge. They're also talking about doubling the capital gains tax rate from 20% on federal level up to about 40%. So you look at all of that and it's just like, oh my gosh, like you really have to defer. If you don't defer, potentially instead of 30 to 50%, like I said in the beginning, it could be 50 to 70%. That's how serious this is, which is kind of mind-numbing to even think about, right? So we come in with the Deferred Sales Trust and we defer this, right? So it's kind of like a 401k or an IRA. It's actually in a manufactured installment sale. It's known as a seller carryback. So Barry, I'll give you an example. If you were to sell a $10 million multifamily property in Vegas, so imagine you own it free and clear. You've owned it for 27 and a half years. You're fully depreciated. And I say, hey, Barry, I want to buy that. And you say, sure. And I say, I got a buyer. His name's Joe. He wants to buy it, Barry. $10 million. Would you buy it from him? And you go, sure, I'll sell it to Joe. Joe gives you all $10 million. You sell it. Well, that would trigger the tax, right? Let's just say 40% was the number. Well, you're going to pay $4 million of tax. You're going to net $6 million. Instead, you can do something called a seller carryback, where you, instead of taking all $10 million in one lump sum, you could take it over an installment over a period of time. And in the meantime, you're not paying tax on what you haven't received. So let's imagine Joe gave you a 0 down payment. You could carry back the note for $10 million. In that scenario, you haven't paid any tax because you haven't received anything yet. Now, on the interest payment, you'll pay ordinary income tax. So this is where we come in on the Deferred Sales Trust. We say, Barry, we don't want you to finance Joe completely because that's not going to give you a lot of diversification. You're going to have to count on him. The funds are going to be illiquid. You might have to foreclose. Let's insert the trust. Let's ask Joe to go get a loan for $10 million somewhere else, right? Or bring it all cash. And instead of financing Joe, you're going to finance the trust. And the trust is going to turn around and sell it to Joe, the ultimate buyer. When we do it in that order, what happens is you end up with a promissory note and you're in a deferral state, but you can invest it wherever you like. Where? Stocks, bonds, mutual funds, hard money lending, ground up development. You can start a new business venture. As long as it has economic purpose and substance and business purpose, you can keep it deferred. Okay, the IRS likes this because it actually spurs economic growth. It's the same reason we don't want them to get rid of the 1031 exchange, because we believe it actually gets them more tax revenue, more tax dollars, because you're incentivizing people to trade, let's say, a 50-unit apartment into 100 units and improve that. And that creates more jobs, more tax revenue, and better housing. Hopefully they stay there. But I'll pause there. I said a whole lot. Make sure that's making sense.
Yeah, no, it's really cool. And it's like you said, it's it's great that you talked about the demographics and, you know, the reason why this is needed and why, you know, it's something that people should really take into consideration, right? It makes a lot of sense. Just a few questions to start off with is so you essentially sell your property to that trust, right? And then that trust sells it to whoever the buyer is. Well, how do you set that up with the trust? Do you does it in your name? What kind of rights do you know? What is the legality of that with a trust?
Great question. This is what we do every single day, right? So we help facilitate all of this. My role is a third-party unrelated trustee, very important, okay? And we're like the offensive coordinator, and you're like the quarterback, Barry, right? And there's also a couple other people. There's a tax attorney legal team, who's a CPA tax attorney, who's thousands of closes, 25-year track record, billions under management, okay? Financial advisor, and we're all playing our role, and you're the quarterback, right? So we're making sure that you don't throw an interception, if you will, right? We're really making sure that you follow all the guidelines. So what does that look like? Well, first of all, we take all the pressure off in that you're not selling this thing to us today and we're just going to look for a buyer, right? You're also not paying us anything unless the deal closes. So there's no cost, no obligation. But step one, make up a name. You can call it the Hulk Hogan, Deferred Sales Trust, whatever.
I love that.
Name. It's a single entity business trust that only does business with you. Okay. And second, we insert the language into the purchase and sale agreement. Third, we help you sell your property. Four, the funds go to the trust instead of going to you personally. And this is important. You've become the lender, the bank, you're the bank now. You're the chairman of the bank. So you don't own the trust. You have lent to the trust. This is important. Now, the funds don't move without your signature. It's 100% protected, 100% safe. We use huge banks to hold the money. Everything's 24/7 access to view the funds online. But it's because of the lending part, right? We're IRC 453 versus IRC 1031. 1031, you're just selling ownership of an asset and then moving it into another asset that you own. In this scenario, you are lending to a trust which you do not own, and therefore you're receiving payment. What's the payment? Typically about 8% net of recurring fees over a 10-year period of time. That's compounding, right? So that $10 million example, you're going to receive, depending on your risk tolerance, probably 8%, depending on how the funds are invested. And we get that. It's not guaranteed results, right? But around 8%, give or take, over a 10-year period of time. And from that point, you also have unlimited time to invest in whatever you want at any time. So you can sell high and buy low, which is really important. In fact, one of the best deal stories I know is that we call it the Monday morning quarterback. This gentleman in Minnesota, he's worth about $200 million. He sold a property in 2006 for $20 million. And he said, you know what? These values are so high. I don't want to overpay in this 1031. I'm going to use the deferred sales trust thing. So he parked the funds into the trust, put some conservative investments, stuff that wasn't subject to crazy stock market dips, right? Just really safe stuff. Paid off his debt and just waited. Well, 5 years later, Barry, that bank calls him up and says, hey, you know that property you sold to that, that Joe buyer who overpaid for it? Yeah. Well, we just foreclosed on Joe and we're just curious if you want to buy it back. Well, maybe. What's the price? They said, well, about 40% less than what you sold it for. So he says, yeah, that sounds like a pretty good deal. So what did he do? He sold out of his securities positions. He reallocated the investments to an LLC, and then he purchased that property back, all tax deferred, not using a 1031 exchange. Okay, so he sold high and he bought low. He didn't sell high and buy higher 180 days later, competing for offers, running around with too much debt, not enough liquidity, knowing he's overpaying, right? And that's like the one message, if I can get out to your listeners right now, is A, if Biden takes away the 1031, then it doesn't matter anyways, because we're gonna be one of the only, I think the only game that's really viable and so flexible, the best solution in town. But two, even if you're looking at the 1031 exchange, do you really want to overpay? Do you really want to take on all that debt? Do you want to have very low cash on cash return? By the way, if you can find a deal, by all means, go for it. But we don't want anyone to ever feel like what the clients I saw on the streets in Sacramento getting hammered. I mean, guys who had, one guy in particular, he had a $20 to $22 million portfolio. He had a ton of debt, and we pleaded with him. But this is like in 2006. Sell. This is the time. No, he's got it all figured out. He lost everything. Everything within 4 years was just gone. And it's like, had he just done this one thing, done the deferred sales trust, paid off all of his debt, waited on the sidelines, he wouldn't have to go through all of that heartache and pain. And so we can't get the message out fast enough, but it's getting out, and more people are looking at the deferred sales trust and using it.
Yeah, yeah. And so then going back to that with a deferred sales, so you sell it, you have a promissory note, and you said it usually pays 8%, or is that up to you? How do you decide how much you can pull out, where that money goes? Like, you in that example, let's go back to the example, right? The $10 million, you put the $10 million into that trust, right?
Yep.
And then that, because it's been bought by that buyer, and then what do you get from that? How much can you access? How much can you go through without triggering any sales? And yeah, how does that kind of work?
Got it. So first of all, you only pay tax on what you receive. Okay. So, and what do you receive? Based upon what terms we set up with the promissory note. Well, what kind of terms can we set up with the promissory note? Whatever you like. It can be interest and principal. It could be interest only. We can delay the payment for a couple of years and then make it. So I think about 50% of my clients will delay the payment for a couple of years and then start receiving payments. And in the meantime, it's compounding and growing, but it's accruing interest, and then they start receiving payments. The other half will start taking payments immediately. There's no wrong answer. It just depends on your income needs and where you're at. But realize that it's flexible. Along the way, it can be adjustable. You can adjust it. Now, the 8% is based upon a risk tolerance. Everything's mathematical. You fill out a 2-page questionnaire, and if you're married, you and your spouse will. And that 2-page questionnaire determines how and where the funds are invested. It's like the constitution for that. It also determines the interest rate because it's determining risk. So we're trying to mirror the risk with the investments based upon your answers to specific questions. Okay. Then an allocation is presented to you. So could it be 7 or 6 or 5? It could. Most of them are around 8. Again, net of recurring fees. Recurring fees are about 1.5% depending on the deal and how big it is. And then there's a one-time fee of about 1.5% to the tax attorney that he sets it up. So the math is typically we want at least $1 million net proceeds and $1 million gain to make these, the pain big enough on the tax to pay for our fees. But that's kind of a separate topic. But I just wanted to throw that in there real fast. But we're trying to hit 8% net of the recurring fee. So we're trying to earn about 9.5 or so that at the end you can say, okay, I got 10 million and it's been accruing at 8. And imagine you took no money, Barry. Well, that 10 would be worth 20, even more than that. With an 8 at 7%, it'd be worth 20, right? And at 10 years, you can say, okay, I want to renew it again, or I want to start taking income from it. So it's adjustable, it's flexible. It just depends on what you want, if that makes sense.
Yeah, absolutely. So you guys are in charge of, depending on that risk tolerance of the person, you guys reinvest that money for them in stocks, bonds, mutual 100%. Funds, whatever. Yes. Okay, very interesting.
And real estate too, just so you know, it's not, because if it wasn't for real estate, I wouldn't be in this business. I say it's got to be a winner for my clients. It's got to be able to be actively buying with the trust. They can actively, like the guy in Minnesota, okay, and a client of mine who's building 70 units in Tennessee. He sold a $2.6 million business, deferred all the tax, deferred $600,000 of tax, and he's building 70 units in Tennessee, ground up development, all tax deferred. So you can be active or passive. Okay, we're not a Delaware statutory trust. This is often gets confused. A Delaware is just another form of a 1031 where you're giving up all control, you're giving up all liquidity, and huge fees, and you're stuck in there for 7 to 10 years. Ours, you can put it into some real estate passively or actively, some in the stock market, some in hard money lending, some in a new business venture. It's kind of like a self-directed IRA, right? It's very, very flexible, and it gives you the control to go in and out of deals versus being completely illiquid or being tied to one single asset, right? When you're not diversified, if that makes sense, Barry.
Yeah, absolutely. So, and at any point you can use all that money and buy, if you wanted to go, say you start this process and then the second year you have all this money in there and you decide, hey, I've just seen a great property, I want to buy this property. Can you take it all out? Or is it, like you said, a 10-year thing where you have some flexibility?
You can do both. So you can take it all out and pay the tax, but you're probably not going to do that. You're going to probably form an LLC and reallocate the investments that were maybe more passive and move it into this LLC. And in partnership with the LLC, this is the magic. You haven't paid $1 of tax. You go buy that property, all tax deferred. Okay. So we're going to use, by the way, what's the $4 million that's accumulating? What's the interest rate on that to the government? What's the zero interest rate? So they say if you're married, $10 million per married couple, all of it's deferred. So that $4 million is a zero interest loan from the government. So using the money that you would have paid to the government to build more wealth, okay? And then as you receive payments from the trust, you'll pay ordinary income tax. And as you dip into principal, you'll pay capital gains tax, right? But you don't you don't have to dip into principal. You can keep that and just live off the interest. So it's totally flexible. It's your money. How do you want to receive it? Most of our clients like to just keep the principal intact and just slowly take payments. Then you can pass it to your kids. Your kids can step into your shoes. They can keep this thing going, and it just keeps rolling, if that makes sense.
Yeah. So essentially, if you never touch that principal, you would keep deferring that as long as it's just some kind of interest, and you pay ordinary income tax on that, but you're not paying the large capital gains amount. So you could keep deferring and deferring and deferring.
Exactly. And on top of that too, that new property you just bought, guess what, has a brand new depreciation schedule. So in a 1031 exchange, had you done that, you have an old depreciation schedule, because the 1031 exchange, the depreciation schedule travels. But since you're not doing a 1031, you're doing a deferred sales trust, you get a brand new depreciation schedule. So that deal in Minnesota I told you about, he sold it for $20 million. His depreciation was really low. Well, when he bought it back through the trust, he got a brand new depreciation schedule. Like that right there that'll pay for all of that one and a half, if that makes sense.
Yeah. That's brilliant. So is there a type of person or type of investor or situation that this works best, or is it someone who has made $100,000 worth of gain, or do you need to be over a threshold for it to make sense? Is it, if you need something quicker, if you're looking in the short term, the next 2 years to maybe leave a job, or is it something for someone is there a range there?
So first of all, $1 million net proceeds and $1 million gain. That's our minimum at this point. Okay. So at least those two things. Now, if you have two properties that fit that parameter or two asset classes, sure. Right. So that's the first thing. So is what you're selling $1 million or more net proceeds, net of all debt, closing costs, and is at least $1 million gain from when you bought it? If so, we think it's a slam dunk. Okay. Slam dunk. Second thing would be, remember, it works for cryptocurrency. In fact, we have a mastermind on this Friday, and you're invited. Anyone else is invited. Depending on you're listening to this, we'll have it every Friday just about. But we're going to be talking about this and how to sell and defer capital gains tax in cryptocurrency, and then go and buy apartment complexes with the money, all tax deferred. Like it's really incredible what you can do. So cryptocurrency, primary homes, businesses, LLCs, S corps, C corps, partnerships. People who want to separate partnerships, maybe one wants to go this way, one wants to go that way. You get separate trusts for each partner, so they don't have to remain commingled, right? They literally can have their own risk tolerance. They can do their own separate deals. Whereas in a 1031, everything must go, right? All the entity must stay in place, not with us. So we're really the Netflix to the Blockbuster way of doing things, right? Barry, the old Blockbuster, you show up on, a Friday night and you see that movie and you want to get it. But before you get there, someone grabs it and you're like, what? That's my movie. You're like, I'm gonna do I'm gonna slam you here, right? But you can't do that in Blockbuster, right? So you settle for the second movie. So then the second movie you forget to return in 3 days. So you get back there and they want to charge you a penalty. So you want to slam that guy too, right? But you can't slam that guy because you're like, where is Netflix gonna come out? But you don't know about Netflix. But then a Netflix comes out. Now guess what? You don't have to drive anywhere. You don't have to show up. It's never sold out. Are there some monthly recurring fees? Yes. So that's the deferred sales trust. We give you all the flexibility, all the diversification, all of the timing, right? One of our clients says it's like a time machine, right? You're giving me the one thing that I've always wanted but never had, which was time. Everything else is so restrictive, but you're giving me time. And that's more valuable than anything. That's why we like to say we're like the Netflix of the industry, if that makes sense.
Yeah, I love that analogy. I heard recently as well on that point. I thought that was quite interesting that in the year 2000, Netflix came to Blockbuster and said, "Hey, let's partner up. We've got this new idea. Let's work together." And Blockbuster's like, "Get out! Who are you? Don't waste my time." Well, fast forward 2020, Netflix is taking over the world, and Blockbuster has one store left. I think they have
there's
one store.
Barely surviving.
Yeah,
exactly right. That's exactly right.
I thought that was so interesting. So okay, so like you said, it's that $1 million threshold essentially of the net gain on a property, right? So and time wise, it doesn't matter. You could be someone that's getting close to retirement, or it could be a younger gentleman that's just wanting to use the funds in many ways. That's interesting. And then you said something there. Talk quickly. I know you do every Friday you're doing a webinar on this, but because I'm sure a lot of people have done pretty well on cryptos. I know it's up and down, but I'm sure there's a lot of people in it. How do you advise people go from crypto to buying apartment complexes? How do you help them?
Really simple. So I'll just give you the actual case we're working on right now, which sparked this whole thing. In fact, the last 2 weeks is a $10 million, $8 million, $20 million, and like $1 million 4 different groups, 4 different states, all wanting to sell and defer. They want to capture the high gains, but defer the tax. So step 1 is you form the trust. Step 2, we set up the exchange with the trust at the exchange. Step 3, we transfer it to this new trust. Step 4, we sell it in the open market. And then you get a promissory note. And now we're at the bank, and now step 5 would be for the LLC and go buy the apartment complexes. So we literally have done it with every other asset class. And now cryptocurrency is really we feel the biggest need, because it has the most amount of risk for people to just lose so much that they've gained if they've gained a ton. So that's kind of the simple answer. But yeah, this Friday, 10 a.m. Pacific Standard Time, shoot an email to Barry and or me, and we'll get you on the list. And we're actually going to be doing this for the foreseeable future. Like, this is literally my number one focus over the next 6 to 12 months, is to help as many cryptocurrency owners out there, Ethereum, Bitcoin, all of it, right, to be able to defer the tax so that they can be passive, they can be diversified, they can be liquid, right? They can get income. In fact, one other case too, they own Ethereum for $100,000. They bought it 5 or 6 years ago. They saw their thing jump to $6 million in 2017, just to see it all crash. And now it's back, right? And now even last week, Ethereum had a crazy kind of run. I think it's doing pretty good today. But the point is, he has 2 kids and they're working 70 hours a week. They're in the Bay Area. And I said, what's your income? And they gave me their income. And I said, well, literally, you could sell and never have to work again. What would that mean for you, right? The time with your family, to be able to travel, to give back to causes you believe in. So this is the transformational exit plan that we provide in Wealth Plan. It's not just tax and deferral, right? That's kind of boring. It's literally, what does it do for you and your family and your legacy, right? And your time and your energy that we never get back, right? And for them, they're like, this is amazing. Now, the biggest things are too good to be true. Who are the CPAs? What's the IRS audits? We have a perfect track record on all of that. All the references you can need, billions under management, thousands of closes. But it is proprietary, it is protected, and not everyone knows what we're doing or how we're doing it. We have everyone sign an NDA. But we just keep closing deals and helping people. So hopefully that answers your question, Barry.
Yeah, and I think that's a really interesting strategy, because, obviously, crypto is very volatile, right? Wherever you stand on the fence with this, right? Is it good investment, bad investment, long term, short term? Is it a store of value? Is it the replacement for gold? Wherever you stand on it, you can't deny that there is volatility. And like you said in that example, people have made a lot of money. And if you can, so what does the future hold for cryptos, right? Again, that's an open-ended question. Nobody knows. People have varying degrees of opinion on this, right? But if you make a lot of money and you've the value of your money has appreciated a lot through that, and like you said, through the example, the Ethereum crashed and then it's back up, and now you can take that money and turn it into income and more of a stable asset, right? I'm not saying better or worse. I don't want crypto people attacking me and coming after me, but more stable, right? It's hard to deny, and it might not appreciate as much, but it's more stable, and it's income coming in every month. And like you said, with those people, they could leave their 70-hour-a-week job and just have this income and turn that crypto into something that provides for them and their family, right?
You nailed it. And then they can spend more time on their crypto investing and go, instead of making just 10 million, go make 50, right? So by the way, we're going to dollar cost average out for this client. He's not going to sell all of it all at once. He'll probably start with 10 grand just to get the pipes flowing, and then $1 million, and then 3, and then 5, and then, just keep pulling it out. And in the meantime, it might go up, right? But he's just taking some of the risk off the table, putting into stable cash flowing producing assets, right? And that income replaces his income. That's the transformation, if that makes sense.
Yeah, absolutely. Wow, this is such an interesting topic. It's such I love stuff where it gives you other options, right? And it's giving you another tool to your tool belt, right? The more tools you have in your tool belt, the more successful you're likely to be. And, if you can just use those when the time is right, it just helps a lot. So it's so interesting. Before we dive into the last part of the show, is there anything I missed? Anything we touched on? Anything that else you should share?
Yeah, we should just mention we can save a failed 1031 exchange, right? We just saved a 128 unit apartment complex for a guy who sold a $7.6 million deal, passed his 45-day identification, couldn't find a deal. You do not have to identify the deferred sales trust, so we can save failed 1031 exchanges. Second, you want to make sure you work with people. I'm in commercial real estate. I'm a broker myself. You work with people who've done this transaction, and I have those strategic alliances across the U.S. and/or I work side by side with them. So whether you're selling your primary house, a business, real estate, You want to work with those who are literally doing it every day, and that's what we're doing. So make sure you reach out on those things to help you prep for this. And the last thing would be estate tax. So estate tax, don't forget about that. That's right now it's set to go from 22 million married to potentially 7 million married and 3.5 million single, which means it has nothing to do with stepped up basis or capital gains tax. It has everything to do with what's in your total estate. They're gonna the proposal is basically 40% of that, right? 40% of that, so which is huge. So we just want to let you know the deferred sales trust. We have one called the Deferred Sales Trust Plus. You can move all of the funds outside of your taxable estate in one single day without having to give it all the way to charity. Okay, we have that solution. We just helped the client in Colorado, $25 million client, all inside of the taxable estate, sold a $5 million property, multifamily, moved it outside the taxable estate. So for the ultra high net worth people who are listening, that is phenomenal. And if you're a commercial real estate syndicator, you're looking to raise funds, we believe this is the number one way to raise funds. And you already have a client base, you can introduce them to the strategy. We can help them to defer it, and then the funds can go with you into your next deal. We have partnerships with, Joe Fairless. We have one with Kevin Bupp. These are very, very respected people. Praxis Capital, Brian Burke, who are doing these types of things. And if Barry is doing these type of things, you can go with Barry. Like, it's really phenomenal what it can do.
Wow. Well, let me ask. I was going to wrap up there, but that's really interesting to me. So if someone is getting ready to sell their property and they wanted to maybe, you can do a 1031 into a syndication, but it's complicated. You have to do a tenant in common, I think. And it's not that easy, and not every syndicator will do it. But in this scenario, they can go with you, do the work with deferred sales trust. Thank you. And then put those funds then from there into a syndication.
You got it. The only caveat is we need to keep 20% liquid. So 80% can go illiquid. 20%'s got to stay liquid, investment grade securities, still your money, still earning interest, but typically like a stock portfolio of 20%. But the other 80 can go illiquid into real estate, passive or active with Barry, with someone, now it has to stay within the United States. That's the other thing. We don't let people go outside of the U.S. for real estate investments, right? So there's a little bit of some guardrails there, but most of our clients, they're not going overseas. They're just staying within the U.S. anyways.
Very cool. Very cool. Wow. This is absolutely fascinating, man. This is such an interesting topic. But as this show is called Wrestling with Real Estate, I like to incorporate some wrestling related real estate questions. And the first one is, what would your wrestling name be?
Yes, I give this a lot of thought. Okay. So I don't know if you've seen the movie. It's called Spaceballs. Okay. And it's a funny movie. And so growing up, my last name is Swarts. Okay. In that movie, they talk about the Swarts a lot. And so my wrestling name would be this. It'd be, may the Swarts be with you. Cause that's what they would say during that movie. May the Swarts be with you would be my wrestling name.
I love that. You said that before. It's got a great ring to it. Every wrestler, as you know, being a fan, has a special move. What is your special move in real estate?
Hands down, the deferred sales trust. It's the one move that can transform versus just doing transactional exit planning. It's transformational once you understand what it can do.
And it can take you from a contender to the world heavyweight champion, right? That's what it sounds like. What's been the biggest body slam you've taken in your real estate
Definitely
career?
2008 crash, right? Went from making a little bit to next to zero, and then humbly having to walk into Cheesecake Factory and kind of beg for a job. And the manager saying, if I'm going to hire you, how do I know you're not going to close a deal within a couple months and just walk away after all the training? I said, no matter what, I have a baby at home, my wife at home. He goes, I want 2 years. I said, I will give you 2 years. And that was the biggest body slam. And at one point, I'm cold calling a guy to sell his $2 million property that day, and that night he's in Cheesecake Factory, and I'm like, oh my gosh. I'm like, would you go tell a different server to go serve that area? Because I'm like, if this guy sees me, he's not gonna let me sell his property. At least that's what I thought in my head. And so the biggest body slam was humbly taking that side job after having 2 degrees and a minor, and working at a prestigious firm, and having to keep that like under the radar. Like I wasn't, I was just really kind of embarrassed, right, in a lot of ways. But I also was very grateful for the job. But I was in a weird spot, and it totally body slammed me.
Yeah. And it's funny how, just to talk about that quickly, it's funny how your mindset, you thought that you were embarrassed about it, but from someone, and I'm sure a lot of people, I have the utmost respect for you at that time to do that, to be able to do that. Like you said, everything else that you had going on, and to be able to then say, hey, I need to do this. This is what I need to do to help my family survive, to put food on the table, to put a roof above their head. I'm going to go to Cheesecake and, serve. And it's not like it's a degrading job or anything.
No, it's a
like
great
that. It's a great job.
I learned so much.
Yeah.
And it just wasn't. I was so like, the way my success was going to go was through selling the real estate, right? Like, and that's had it on my mind. Like, college was, I had to get the basketball scholarship, which I achieved, and so those were the things. And so this just wasn't a part of the paradigm. So, but I loved it. I mean, I actually had the best time. Met so many people, learned more sales skills, more service skills. Cheesecake Factory is a phenomenal place. So, tons of friends. So, but yes, it was a little bit different than the plan.
Yeah, absolutely. Well, thanks for sharing that again. So was there a moment that you were standing on the top rope, getting ready to jump, but you were too scared? What was it, and how did you overcome it?
Yeah, so I mean, it's kind of connected to the Cheesecake Factory part of it, and part of that was also moving in with my brother, and newly married or just married, baby on the way. So it wasn't just me anymore standing on the rope. It was me with my wife and the daughter, and about to be born, right? So it was like, oh my gosh, like this is like getting really fast. And so we're all kind of standing on top of the rope, my wife and I, and I'm like, okay, so we've got to go move in with my brother. Are you okay with that? Well, what does that mean? For how long? Like, we're newly married and the baby. And I'm like, yeah, but this is like the only way. And so the pressure was go get the real job, or the consistent job that, give up the dream of real estate and being an entrepreneur and all those things. And it's standing there at the top of the rope going, no, whatever it takes. As long as my wife, Melanie, was on board, and she, praise the Lord, she was, and she believed in me, she supported me, and she sacrificed for us. So it's us both standing at the rope, and we're jumping into living with my brother in a small condo, taking the side jobs and weekend jobs, working to the grind, 60, 70 hour weeks, and just grinding and grinding for literally over 2 years. And I walked into Cheesecake Factory, I think it was 2 years and 1 day, and I gave them my 2-week notice, right? So I kept my promise, but I was able to retire from the Cheesecake Factory after the 2 years and 1 day.
Man, cool story. And man, I'm so happy for your success as well. You absolutely deserve it. So it's so good to see someone who's worked so hard and, like you said, persevere through that dream, right? Because it's so easy to give in to people's, friends and family all around us, right? And real estate is bad for this, I feel like, because people don't invest in real estate. It's risky, it's dangerous, you're going to lose everything. And everyone means well, right? It's not coming from a place of discouragement. They just want the best for you. But, in the same scenario that you had, right? People were telling you different things, people were thinking different things, but you have to stick to your guns. You've got to have a vision, you've got to have a belief, and you've just got to go for it, right? And I think it's so awesome that you made it through that, and all the success you have now is without doubt very massively deserved. So congrats.
Thank you, Barry. That's really appreciative of you to say that. Very kind of you.
Absolutely, man. Absolutely, man. Well, thank you so much, man, for being on the show. This has just been like I said, such a fun interview. But before we go, if people are interested, if they want to find more about your podcast, if they want to get in touch with you, if they think that they're a candidate to work with you, plug everything that you have, essentially.
Absolutely. Thanks so much. So you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. You can also search that on YouTube, search it on Facebook, as well as on iTunes. So we have our podcast as well. And if Barry's up for it, I'll have him on the show soon to tell his story and everything else. But amazing guests, great people. We talk about real estate. We talk about deferring tax. We talk about leadership. We talk about personal development, a lot of cool stuff. And we also have a free ebook for you. Go to capitalgainstaxsolutions.com. It's basically sell your business, real estate, or cryptocurrency smarter. And it's basically the 9 steps to doing the deferred sales trust, kind of a detailed overview. You can get that now for free at my website. The second place you can go to if you're a business professional, you're like, hey, I'm a luxury realtor, Brett, or I'm a financial advisor, I'm a commercial real estate syndicator, business broker, anyone who's helping high net worth individuals, and you're like, I think the deferred sales trust would be a perfect fit for some of my clients. You can go to experttaxsecrets.com. That's experttaxsecrets.com. And then you can learn how the deferred sales trust can help you help your clients defer tax, and how you can grow your business doing it.
Cool. Very cool. Very cool. Well, thank you so much, Brett, for all your time and all your knowledge, and a great conversation. But let's wrap it up there, I guess, and have an awesome rest of your day out there in Sacramento, man.
Thank you, Barry. Pleasure to be on the show.